about the distinctions between audit and audit-related services. Now, we mentioned that audit, we know that what audit is, we know there's a form of assurance engagement. It gives a true and fair view of blah, blah, blah. Talked about it in our previous lectures. It gives a reasonable level of assurance or high level of assurance. But audit-related services do not provide the same high level of assurance, right? And in some cases, they do not provide any assurance at all. So they provide zero assurance or limited assurance. Number one is what we call, I call it CAR, C-A-R. Number one is, let's say, compilations. Now, what do we mean by compilation? The practitioner is engaged to prepare information rather than to audit information prepared by somebody else. For example, an accountancy firm may be engaged to prepare a tax computation for a client. So that is compilation. So that's C. They have agreed upon procedures, which is A. This is an engagement where the party hiring the practitioner specifies the procedures that the practitioner should follow when performing the assignment. That's A. You have review. So CAR, C-A-R, review of data are checks carried out on information prepared by another person. So those are the audit-related services you have. Types of review engagements. In a review engagement, the practitioner is engaged to review financial information or other information, but not to audit it. So you have the types are an attestation engagement and a direct reporting engagement. Now, when we say attestation engagement, to attest means to vouch for something. To attest means to vouch for something, to vouch for something. In an attestation engagement, a practitioner is engaged to attest to something. So basically, an example would be where a practitioner or an auditor might be engaged to attest to the fact that certain procedures have been performed in the prescribed way. And we also have direct reporting engagements, right? In a direct reporting engagement, practitioner is engaged to provide a special report on some aspects of the client's affairs. So those are the two types, basically, of review engagement. Then we have common forms of direct reporting engagements, right? And one common form is what we call due diligence engagements or due diligence work. I'm sure you've heard it. So this is where the practitioner is engaged to make inquiries into accounts or the organization or to the activities of the organization. So sometimes when there's a merger or a takeover, you see due diligence being done. Yeah. So what are some of the items you investigate in a due diligence exercise? Number one is financial performance. If you are going to do proper due diligence, you check for financial performance. It's just like maybe you are going to buy a car. Check horsepower and all that. Number two, you check also for operational issues. Operational issues. Number three, you check for management representations. Now, what do we mean by all of this? I'll come to that. You also check identification of assets, and you also look at the benefits. You do a cost-benefit analysis, the benefits and cost of the takeover, if it is a takeover. So financial performance, we know, what are the numbers saying? What are the ratios saying? Operational issues, we are looking at things on the ground, like costs incurred, what are the efficiencies happening on ground? What about the labor turnover, operational stuff, things that happen on a day-to-day basis. They have management representations. right? There are situations where management may provide representations to the potential buyer, you know. So in such situations, you need to do due diligence on that. So management, for example, may tell you that, oh, this company, we don't have any litigation. Is it true? You need to find out. Then identification of assets as well. You know, we need to know that what the company is saying, their assets, is it actually part of their assets? We need to do due diligence on all of that. So through that exercise, we get what we call due diligence reports. Due diligence reports. And for those who are doing strategy, one of the things you see in a due diligence report is SWOT analysis. You see corporate governance analysis. You know, these are things we've discussed in strategy. You see legal issues, any audit issues in the past, all these things you see as part of sometimes, most times, as part of the due diligence report. There's no format to a due diligence report, but some of these issues appear. We are still on review. We said that audit-related services are 3: CAGH, compilation, agreed upon procedures, and reviews. Now, what are the principles to apply to review engagements? ISRE 2400 sets out some general principles when it comes to review engagements. So, number 1 is comply with ethics. Number 2, obtain sufficient appropriate evidence. Number 3, exercise professional judgment. These are things you would even do when you are doing an audit. You know, then what are some of the procedures? What are some of the procedures, right? One of the key procedures you see is inquiries. The practitioner shall make inquiries into the entity's accounting policies, practices, and procedures, material assertions in the financial statement that are subject to the review, and all that. It's very, very key. Okay. Then at the end of your review engagements, like we said, you would report. You do a report. You do a report. And this report would include the things we discussed in some of the things we discussed when we are talking about review engagements. The outcome of a review engagement will be a report from the practitioner. The report will be in one of 2 main forms. That no matter came to the attention of the practitioner, or some matters have come to the attention of the practitioner. So if some matters have come to the attention of the practitioner, what do? The auditor needs to describe the matters, you know, the matters involved, assess the impact of those matters, and determine whether it is material or pervasive. Determine whether it's material or pervasive. Now, I just put this in to show you an example of a review of the interim financial information. So introduction. So there's a title, there's an appropriate addressee. The introduction says, we have reviewed the accompanying balance sheet of Caleb entity as of March 31st and the related statements of income, changes in equity, and cash flows for the 3-month period, and a summary of blah, 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 blah. Management is responsible for the preparation of the financial statements. It's always there. And it tells us the scope of review. So you have an introduction, you have a scope of review. in accordance with international standards on review engagement, it will tell us that we did so and so. So a review of interim financial information consists of making inquiries. So that's the procedure here. Primarily of persons responsible for financial and accounting matters, and applying analytical and review procedures. Then one of the key things that they mention is that a review is substantially less in scope than an audit. It is less in scope. So that's the scope of review. Then it comes to talk to you about the conclusion. It's either it will say nothing has come to our attention. If something has come to our attention, they mention it. Then the auditor, the dates, and the address. Now let's talk about agreed upon procedures. Agreed upon procedures. And agreed upon procedures engagements. The client has the client also engages. The client that engages also decides the procedures that the accountant will follow. They'll decide the procedures that the accountant will follow. This is very different from an audit engagement, where the auditor decides the procedures to be followed, right? So that's something to take note of. Now, the international standards on related services, ISRS 4400 or 4400 or 44400, talks about this whole agreed upon procedures thing. Now, one of the things that they talk about that I would want you to take note of is that because the one engaging is the one that decides the procedures the accountant will follow, in the engagement letter, it should be set out. You should say it should be there in the engagement letter so that everyone is clear on exactly what is happening. Now, this is a report of agreed upon procedures. One of the things that I didn't talk about, if you look at the first part of the slide, you would see that it says that the accountant provides a report on factual findings from the procedures performed. Factual findings. No assurance is provided. No assurance is provided. It's very, very crucial. You need to understand this. No assurance is provided. So if you look at this example, it says report of factual findings. So you see, report of factual findings. Can someone please read this? Can someone please read this report, if you can see it? Hey. Anyway, so it says to the board of directors, of so and so company, it talks about the report of factual findings. We have performed the procedures agreed with you. You have performed the procedures agreed with you. That's how it will start. And then you insert a list of the agreed upon procedures. Then then you report your findings. Then you make sure that you say that this is not an audit or a review. And so we do not express any assurance on the accounts payable as of dates or whatever account you are working on. Had we performed additional procedures or had we performed an audit, other matters might have come to our attention that would have been reported to you. You state the auditor, date, and address. Simple. Very, very simple. Now let's talk about compilation engagements. So we have CAR, compilation, agreed upon procedures, and reviews. We are finally in the zone of compilation engagement. So in a compilation engagement, the accountant is engaged to prepare financial statements or other information, not to audit. So an example is the preparation of financial statements for a sole trader or a club or association. So the firm is usually engaged for its accounting expertise, not its auditing expertise. Its accounting expertise, not its auditing expertise. No assurance is provided by the accountant. No assurance is provided by the accountant. And the reason why it's called compilation, as you might have heard, is the work normally involves the collection and summarizing of information. So you are compiling information. Okay. So this is how a compilation report looks like. It says we have compiled the accompanying financial statements of ABC company based on information you have provided. These financial statements comprise the statement of financial position. Again, you see the title, you see to management of ABC company, etc. We perform this compilation engagement in accordance with ISRS 4410. We have applied our expertise in accounting and financial reporting to assist you in the preparation and presentation of these financial statements in accordance with IFRS. Since a compilation engagement is not an assurance engagement, we are not required to verify the accuracy or completeness of the information provided for us. The auditor will make sure that you say everything so that in case of any trouble, you don't hold them accountable. Have the practitioner's signature, the practitioner's report, and the practitioner's address. Any questions? Any questions? Because we have, let's see, we have quite a... Okay, if there are no questions, since there are no questions, if there are no questions, then let's just move on. So we'll talk about assurance services, the need for assurance services, right? Traditionally, the assurance role of the professional accountant has been concerned with the provision of audit services. So if you look at a lot of big four companies, you see audit and assurance, right? You see audit and assurance. However, the management of companies and other organizations are required or expected to report to stakeholders on a wide range of information, both financial and non-financial, that is not subject to statutory audits. So it includes issues around systems reliability, e-commerce, corporate governance, value for money, etc. It's very, very important. Now, we've been talking about levels of assurance. So you might have heard reasonable level of assurance that you might have heard about it. In an audit, a reasonable level of assurance is given. So a reasonable level of assurance can be given only if the accountant is carrying out an assignment that looks at information that has not been prepared by the accountant, right? So if the auditor didn't prepare the information, and is working on auditing that information, then he can go ahead and say and have a reasonable level of assurance over that audit or that engagement. Very, very important. That's what I mean by reasonable level of assurance. We've explained it in several ways. A reasonable level of assurance means that you gain some level of assurance or a high level of assurance based on the audit evidence you gathered, and you're able to gain some level of assurance, basically. Now, we also have limited level of assurance. Limited level of assurance. So you might hear the term limited assurance, limited assurance, limited assurance. You know, what is limited assurance all about? It means that you give a limited level of assurance where the risk is higher than that for an engagement. Sorry, let me get my thoughts together. You give a limited level of assurance. So a limited level of assurance simply means that the assurance that is obtained and provided by the auditor in an assurance engagement what am I even saying? So a limited level of assurance is like it's what they say in audits, like negative assurance. It's what they say, negative assurance. And what does it mean? It simply means that it usually happens on reviews. It usually happens on reviews because you didn't go the extra mile to gather all the evidence you need to, you know, to be able to have a reasonable level of assurance that you perform substantially all the procedures that you needed to perform for the audit work. And so your level of assurance is limited. So here I say that where only a limited level of assurance is given, the risk is higher than that for an engagement where the accountant is able to give a reasonable assurance. So limited level of assurance is lower. It's lower. It's lower. Where only a limited level of assurance is given, the risk is sufficiently low to allow for a negative expression of the accountant's conclusions. So that's basically what a limited level of assurance. It is only in an audit that you give a reasonable level of assurance, because in an audit, one, you did not prepare the financial statements. Two, you have control over the procedures. And three, you have ability to, deploy sampling techniques and gather the evidence that you require to give an opinion on the financial statement. Limited level of assurance, you don't have that, you don't have that because you didn't do that extent of work. It's like somebody has given you a book to edit, right? An audit is like you were able to read, if it's a 5-page book, you're able to read, maybe 4 pages or 3 pages. We're able to read and find some errors. That's like an audit. But for audit-related services like reviews, agreed upon procedures, and compilations, you are basically not going into a lot of detail, so, you can't give a lot of assurance. So if your friend asks you, oh, did you find any mistakes in my writing? You can't give a high level of assurance. You can only give a limited level of assurance. Okay. You also have non-assurance engagements, which is management consulting. Examples: preparation of tax returns, agreed upon procedures, etc., etc. Okay. We've talked about the objectives of an assurance engagement, over and over again. Over and over again. The elements of an assurance relationship. I think we would have talked about this. An assurance relationship is a three-party relationship, right? We talked about the practitioner, the party responsible for the subject matter of the engagement, and the intended user. I think we've talked about this. Correct me if I'm wrong.
That's the first, I think, either
that's the first lecture.
The early part of the lecture.
Yeah, that's the first lecture. Okay. So every situation has the kind of conclusion. So if you have a limitation on scope, when we say a limitation on scope, what do we mean? When we say a limitation on scope, what do we mean? So a limitation on scope is basically where the auditor has been restricted. Please take note of this. And so it makes it difficult for the auditor to do their audit and come up with any reasonable conclusions. So the scope has been limited. And how does this happen? Right? It usually happens when the client is not giving the auditor the information that is needed. And the auditor also can't find any alternative procedures to, conduct the audit. So if the auditor is not able to obtain sufficient and appropriate evidence, it limits the scope. Also, some scope limitations arise which are beyond the control of the client, like a fire could happen, a flood could happen, So the impact on the conclusion will be a qualified conclusion or disclaimer of opinion. I hope these, does everyone know what a disclaimer of opinion is? Because I'm assuming that you know it from normal auditing, not advanced auditing, but the normal audit paper you wrote. Please give me feedback if you know what disclaimer of opinion is.
It's a reminder will do.
A reminder will do.
Yes, sir.
So when we say a disclaimer of opinion, like sometimes you see on a freight, like on something, a service, a product, they'll say disclaimer. A disclaimer of opinion is basically a statement made by the auditor that no opinion is being given. We didn't have the information to do the work. So how do you expect us to give an opinion? So that's what we call disclaimer of opinion. We are not giving an opinion because we are restricted. When we ask the client information, the client doesn't give to us. We also couldn't find any alternative procedure that will help us to do the audit. Or some flood happened or something happened. So we can't give an opinion, Yeah. Another situation is the assertion made by the responsible party is not fairly stated. That leads to a qualified or an adverse conclusion. A qualified or an adverse conclusion. So since I have to explain all these things again, let me just explain again. So what's a qualified opinion? When we say a qualified opinion, it means the opinion has been qualified in a certain way. When we say unqualified, it means that the financial statements are good. Unqualified opinion, the financial statements are good. They are fairly presented. Now, when we say qualified, it means that the financial statements are fairly presented with the exception. That's the key. With the exceptions being qualified, with the exception of a specified area. With the exception of a specified area. So that's what we mean by, what do you call it? A qualified conclusion, sorry, a qualified conclusion. Then we have adverse conclusion or adverse opinion. An adverse opinion is simply an opinion made by the auditor that the financial statements have been misstated. That one has been misstated, it's been misstated and misrepresented. And it's not fairly stated, basically. So you have unqualified, everything is fairly stated, qualified, fairly stated, with the exception of a particular area. Adverse is been misstated. If the subject matter has been materially misstated, you can either get a qualified or adverse conclusion. The criteria are unsuitable or subject matter is not appropriate to an assurance engagement. You can get a qualified or adverse conclusion if users are likely to be misled. Otherwise, a qualified conclusion or a disclaimer. Please, this thing, always remember it. Always remember it. Now, we've talked about value for money in strategy, right? We've talked about economy, efficiency, effectiveness. Economy, efficiency, effectiveness. So when we say, so we see value for money here again, right? When we say economy, what do we mean? It means that you are spending money carefully. When we say efficiency, we are using input in such a way that it will produce the highest amount of output. When we say effectiveness, we are talking about, using resources to achieve intended objectives. So you have economy. For those who are doing strategy, this will help you. Economy means doing it cheaply, efficiency, doing it well, effectiveness, doing the right thing. So that's something to take note of. Take note of. Now, when we are talking about engagements and assurance engagement, we talked about engagements related to systems reliability, engagements related to e-commerce matters, and all of that, right? We talked about all kinds of issues like that. Sorry, I think I missed the slide. Now, there are times when as a company, you would have to find out how reliable your systems are or how reliable your e-commerce platform is, And so management and other stakeholders would engage a practitioner to give assurance on the effective and secure operation of their computer systems. So it happens. These are engagements related to systems reliability. There are also engagements relating to e-commerce issues. E-commerce issues as well. We know that there are all kinds of risk that e-commerce brings. And so management should carry on an ongoing basis to understand and assess all the risks related to e-commerce. All the risks related to e-commerce. Okay. So, this is where I'll slow it down for today. But before I do, I would like to explain what the term continuous auditing is. Continuous auditing. Continuous auditing. When we say continuous auditing, it's simply a process which allows auditors to give assurance on a subject matter concurrently or shortly after the occurrence of the event on which assurance is being given by using automated procedures. So continuous auditing is you are given assurance in such a way that you give it right after the event, or even you do it concurrently. So when an event happens, then you audit, and you can only do this with automated procedures to give you that close to real-time effects. You can only do that with automated procedures. So you need both auditing skills as well as some technical skills to understand how these automated procedures work. Yes, so that's it for today. Let me know if you have any questions, and then we'll call it a day. Any questions? Any questions? Okay, seems like there are no questions at this point. So if there are no questions, let me give you my tips that you need to pass this exam. Like I said, please remind me on that summary book. So that summary book is very, very useful. Remind me so that I post it on the group so that you can start using it to reading it. So someone should remind me. If you don't remind me, I might forget. So thank you and have a nice rest of your week.
Thank you, sir.
Okay.